The implications of China's profound economic problems, which we've been talking about for the past year or so, finally spilled over into a full-scale global market rout in August, culminating in Black Monday on August the 24th, when China's stock market collapsed by a further 8% and virtually all other markets, both developed and emerging, suffered equally sharp falls in conditions of near panic. The VIX Fear Index spiked sharply higher, and but for a rally in the final couple of days of the month, markets would have been even worse than the 6% decline over the month in developed markets and 9% in emerging markets. This latest leg down in markets brought cumulative peak-to-trough falls since April-May this year to around 12% in developed markets, the biggest correction in this long bull market since 2011. Emerging markets have fallen much further, down 28% since April, in an acceleration of the bear market which started in mid-2011. China, the immediate cause of the latest falls, has fallen by an extraordinary 43% since mid-June, wiping out a large part of the equally extraordinary bull run of the previous 12 months. The trigger for the falls in August was the surprise decision by the Chinese authorities to devalue the renminbi by around 3% over a period of 3 days early in the month. Aside from raising questions around currency wars and the competitive impacts on other countries, especially, of course, its Asian neighbours, the policy shift highlighted the deep-seated problems in China and the difficulties faced by the authorities in maintaining growth at anywhere near their target of 7%. Coming on top of a collapsing stock market and series of poor economic data releases, including trade figures and leading indicators now running at their lowest readings since the financial crisis, as well as clear deflationary trends, the producer price index now in its 40th consecutive month of decline, the devaluation alarmed investors and led to fears that the slowdown in China is much greater than the official figures would suggest. In turn, given the enormous size of the Chinese economy, now 15% of the world economy, this created concerns that growth would be impacted globally with negative implications across both the developed and the emerging world. The most obvious damage from the slowdown in China has been to commodity markets and resource producers. The end of China's huge capital investment program of the past 15-20 years has brought steep falls in demand for and prices of commodities over the past 3 years, and these falls continued into August. But a rally in the final few days of the month saw a recovery, and in the case of the oil market, took prices higher over the month. The currencies of emerging markets and commodity-producing countries also came under pressure with falls of 5 to 10% in many Asian currencies. However, the general risk-off environment and fears of slower growth resulted in indiscriminate selling across stock markets globally, especially in those sectors most exposed to a slowdown in growth and those companies with sizable exposure to China. But the key question now for investors is whether the correction we're seeing signals the end of the bull market and the beginning of a major downturn, or whether this is another, albeit particularly sharp, correction in an ongoing bull market. We are firmly in the latter camp and see the setback as an opportunity to add risk and buy equities, particularly in those developed markets which have suffered steep falls in the past few weeks. While China is a huge economy and its slowdown will impact on global growth, much of the damage will be limited to China itself and to resource producers, which were the greatest beneficiaries, of course, of China's boom of the past 20 years. Indeed, the falls in commodity prices triggered by China's reduced demand are having and will continue to have a material beneficial impact on developed countries, keeping inflation at low levels and boosting real incomes and hence demand. This will sustain the modest growth we're seeing in developed country economies. Furthermore, China's slowdown is largely in capital spending. As we've said many times, China's investment spending boom has become unsustainable. It's resulted in a serious misallocation of capital and oversupply of productive capacity in many areas of the economy. In contrast, consumer spending is likely to be more resilient, and the consumer will become a much bigger proportion of the Chinese economy in future, a development which will ultimately result in a more balanced and sustainable, albeit slower, growth rate. In addition, other than for resources, China is not a major export market for most countries. The impact of slower growth will by no means be negligible, and it will have continuing negative implications for certain sectors and individual companies, but it won't be enough to derail the recoveries underway in the developed world. Slower growth globally and the deflationary pulse of China's rebalancing economy are likely to persuade central banks to keep monetary policy on hold and policy ultra-loose for longer. A September rate rise by the Fed is increasingly unlikely. Indeed, the first rise might well not come until 2016. In the case of the European Central Bank and Bank of Japan, policy might even be loosened further, a possibility hinted at by both central banks in recent days. Any rate rises, when they eventually come first from the Fed and then the Bank of England, will be small and gradual. In the case of China itself, the People's Bank of China eased policy following the sharp market falls, cutting interest rates and lowering the reserve requirement ratio, and there's a strong likelihood that policy will be eased further in coming months. There's no question, in my view, that central bank policy will continue to provide a strong underpinning to equity markets and risk assets for some time ahead. At the same time, the evidence from the developed world is pointing to continuing modest but sustainable growth at a level which is very unlikely to trigger the sort of capacity constraints and inflationary pressures that typically would cause excesses to build up and policy to be tightened. It was notable during the dramatic sell-off of risk assets in August that there was no great flight to safety. US Treasuries, the world's safest haven, saw little change in prices and interest rates, a pattern followed by other safe haven government bond markets. The US dollar, usually the beneficiary of a big market sell-off, actually weakened against the euro and the yen, while gold had a modest rally, but it couldn't be sustained as the month progressed. It seems to me that investor expectations have rapidly adjusted to events in China and a rebasing down of global growth. The process of adjustment is painful in some sectors and countries, and especially in China itself. But in our view, its impact on the developed world is much less than would be suggested by the sharp falls in stock markets and other risk assets in recent weeks. With valuations now materially lower than 3 months ago, we view this as a good opportunity to add to risk in portfolios, something we've been implementing on a gradual basis during this period of weakness. We recognise that markets have the hurdle of the Fed's first rate rise on the way, and there will be further bumps to come, but we remain firmly of the view that this bull market has considerably further to run in this particularly long business and market cycle.